Hello, hello, and welcome back. We are here talking about retirement. And Dave, you are here with us again. This is amazing. 2 weeks in a row.
Yes, CR, my house is still here. It looks like your house is still here. Not sure how much of the storm you had come through that direction, but sure a lot of destruction below me here down in Mississippi.
Yeah, not a lot here. Just we had lots of rain. That's it. So tell us about the storm and what's happening.
Yeah, so really nothing here. I mean, we got a bunch of rain, some wind, which I think's good. Blows a lot of those leaves down that I got to rake up at some point anyway. But a lot of destruction. I know there's some flooding towards Memphis and down in that southern area. Always tough, man. It's just amazing how you can wake up one morning and everything's good and beautiful, and by the end of the day, people have struggles going on due to Mother Nature.
Yeah, exactly. Or here it's 60 degrees one day, then the next day it's 20. So
Yeah, yeah, definitely a lot of variety there.
well, Dave, we're glad you're here. It looks like you're back in your home studio, which we're really excited to see because it sounds like sometimes you get to take a break from the office and go to another office.
Yeah, no more hotel for me for hopefully till the end of the year at least. I think January I've got another trip going, but hopefully we're here in this office for good. Got the carpet all laid down, all the repairs made. Hopefully we have no more issues.
Well, that's good. Well, we're glad you are back. We're glad you're here with us because, as always, we're in here talking about retirement. We're answering all of the questions that come in, obviously, from our website, from webinars, from social media. And we put all those together. And then we ask you that are here with us live to go ahead and submit your questions as well. So we can send all these to Dave and have him give us some feedback on all these questions we have. And Dave, last week we really dove into Social Security and Medicare, and we just had a ton of questions. This week I changed it up a little bit, but let's go back and just talk about that Social Security and Medicare because that's a big topic that most people just aren't getting right.
Yeah, it is. It's something that's so important to every one of us. 96% of Americans are going to use either one or both of the programs. And yet here we sit going into our retirement years with items that are so important, just not understanding even what we should be doing. And unfortunately, the majority of people make mistakes, especially with Social Security. 96% of people not going to end up claiming benefits at the right time for themselves.
And Dave, we are here again talking about retirement again, answering questions. So I just wanted to let everyone know that as we get diving into our questions today, that if you have anything you want to ask, go ahead and get that in the comments. You can do that on Facebook or YouTube Live. And again, if you are here on replay, go ahead and submit that to our website at retirementriskadvisors.com/questions. And I'll have all those links at the end. But Dave, if you're ready, and I do have one Social Security question to kick us off, Dave, if you're ready.
Sounds good.
All right, so this one is coming from Darla. Does claiming Social Security too early keep you from earning money too?
So that is an interesting worded question, Darla. So it doesn't keep you from earning money, but your Social Security can get reduced if you do earn too much money. So again, I think we've got to look at this as no, government programs aren't designed to keep you from being profitable and working and doing all of these things. They're designed to where if you are going to be working and productive, there's benefits you may not get at this period of time. And so my thing would be, hey, let's go out and work if we need to work, and then delay those Social Security claiming strategies we're going to use and allow that money to come in later in our retirement.
Dave, what happens like in case like let's say Darla here, if she earns a higher salary than she did while she was in her earlier career?
Yeah, so if she is in a position where she's still getting her 35 years of earnings, or these are higher than any earnings she's had during a 35-year period of time, she is going to be able to have her benefits continue to increase. And understand too, if your benefits get cut off because you do go to work, or you are working with Social Security before full retirement age, you're going to get that money back. They're not just taking it away. And that's a misconception many people have. And again, I think part of why we get this question coming in the way it is, that somehow it's a penalty to us if we happen to go make some money and be productive if we're already on Social Security. And it's not designed to be that way. The best thing most people can do for their retirement is work a few years longer, because there are three things that end up happening. Number one, you're not dipping into savings. Number two, you've got earned income that's covering your costs. And number three, usually you are saving some of that money. So all the things that you really need to have happen to help your retirement, working could be one of the best things you can ever do.
Dave, I saw this question through another series of questions as we were putting these together, but someone was asking, are your Social Security benefits taxed if you are still working?
Yeah, so if you look at it, yes. And I guess you've got to figure how that question's being worded. If you're still working, then all of your W-2 earnings are still paying Social Security tax on those. So that's answer to number one, that you never get out of paying Social Security if you're going to work. The other side is if you have not only earned income, but other income coming in on your tax return, be in a position to where you'd have provisional income, and then you would have tax on your Social Security benefit. So yeah, government's going to try to get their piece of the pie every chance they get. Now, understand if you are paying in, again, if they're higher years of earnings, you're going to get some benefits back because of that.
And Dave, the last question I just wanted to ask, can you rescind benefits claimed and maybe have an initial start over?
Yes, you can. And there's really three ways to do it. There's an official way where if you do it within 12 months of claiming your benefits, you can file what's called a Form 521 with Social Security Administration and rescind those. Now, if you've gotten benefits already, you're going to have to send that money back. You're not going to be able to keep that. And if there's someone else on your work record that's been getting benefits, their money would have to go back and they have to approve of you rescinding the benefits. So if you're not getting along with someone else that may be claiming the benefits, you're not going to be able to allow that to happen. That's the official way. The other way is to go back to work before full retirement age and phase yourself out, earn enough money to where your benefits would be phased out and then get delayed. And then once you reach full retirement age, you can start and stop at will. Now, not going to be done every day. You're not going to say on the 5th of the month, I'm going to start up and the 20th, I'm going to stop. It doesn't happen that quickly. But I see people where there are times that you may collect for a year or so and then stop collecting benefits for a year or so and then start up again back once you get to age 70. So there's some strategies there that can get you the maximum benefits.
All right, Dave. Well, let's jump to my next question here from Rob. What is the best way to find a long-term care policy or annuity with a long-term care rider?
Our recommendation is to reach out to our office because when we talk about these things, again, I often compare them to a car. You're not just getting, you go out and say, okay, I tell CR, will you please go get me a vehicle? Now, he knows a lot about my family, so he may get something that would work for my family. But if you didn't, you go onto the car lot and there's that new Corvette there that you're saying, hey, this thing's super awesome. This is going to be great. Dave's middle age, going through a crisis. I'm going to get him that sports car. Well, I've got 8 kids. I don't need a sports car. I need a van with a chair lift and all these things that you've got to have when you've got disabled children as well. And this is the way that we see these policies. So many people are going out and saying, oh, I need a long-term care policy. I need a life insurance policy. And then they're buying them and they're not meeting their needs. They don't have all the requirements that they need to have to really solve the issues the way they can.
Dave, let me just go back and ask, so how does this life insurance with a long-term care rider work?
Yeah, so if we look at the life insurance side of it, what happens is what we recommend is the chronic illness rider. You can buy a permanent life insurance policy with a long-term care rider that you'd pay for separately. Chronic illness rider just allows you to use your death benefit in advance if you've got a long-term care issue. If you can't do 2 of the 6 activities of daily living, a doctor says you can't do those, you're going to get some of your death benefit in advance, about a quarter of it per year. It goes over a 4-year period. You've got to leave some to make sure the insurance doesn't lapse. But it can be a great tool to help people deal with an issue that most of the world's not solving. In fact, only about 6% of America has solved the issue of the long-term care event.
And so, Dave, how do we receive those payouts from a long-term care rider?
Really, all you've got to do is reach out to your insurance carrier and provide the doctor's note and the paperwork that they require, and then they're going to send you a check or direct deposit money into your account for the portion that you're entitled to. Now, if you have a $400,000 policy, and again, we break it down over a 4-year period of time, if you're age 86 when it happens, no, you're going to get a reduction because the insurance company is paying you out early. They're not going to give you the full amount because they're expecting you to live to age 100 before they'd have to pay that $400,000 out. You will get some reduction. But again, a great way to be able to solve a problem that many people are struggling to find a solution to.
And Dave, just my last question with this, are there any waiting periods or requirements that we need to be aware of as we're looking at these long-term care riders?
Yeah, on the life insurance, no, when we look at it, as long as you can't do the activities of daily living. Now, for a long-term care policy itself, yes, there's usually a benefit period, can be up to 6 months. Most of them are about 90 days, but you would not be able to get any benefits until you get through that 90-day period. And note too, usually you've got to pay out the cost. It's not one of those things that your family's coming in and say, okay, George, you know what, we realize you got problems. We're going to cover you for the next 90 days here at the house. But after that, we got to go back to work. We got to take care of our own families. Let's go ahead and get your long-term care insurance, pay everything. They're going to say, sorry, you got to wait another 3 months because you didn't have any out-of-pocket costs during the initial 3 months.
Very good to know. Dave, let me jump over to Nisha's question. How are required minimum distributions calculated per person?
Great question. So each year, the government does provide a schedule showing us what the required minimum distribution amounts are going to be. 2022, it is 3.65% for a 72-year-old, and then it's based on age. The older you get, the more you've got to take out. I haven't seen the 2023 schedule. I'm assuming it's probably out already, although I've not seen it. In 2021 is 3.91%, and now we're at 3.65. So going to be somewhere around there. And then each year it just slightly goes up as you get older.
Well, so Dave, if we're talking about these RMDs, what if they decide they don't want to take it, or they want to withdraw maybe too little?
Yeah, don't do that. You're going to get a 6% excise tax for any of you that decide to do that. And actually, I think it's more than that. I said 6%, but I think it's half of the value there. It's a huge penalty if you end up not taking those RMDs out. So please do not do that. You need to make sure you're pulling them out. One of the bigger questions we often get, though, is when you do your modeling, you show that we can't spend that much. So if I've got to take 4% out and I can only spend 3%, what do I do? You don't have to spend everything you pull out. This is, again, part of the problem it seems like America has. We get money in our bank account, and for some reason, we think it's got to be emptied out every month before it gets filled up. Yeah. Not the case. You're going to have to reinvest some of that money so that you have it for your future.
And Dave, what type of accounts require these RMDs?
Regular IRAs, 401k accounts, both Roth and regular. The only one really that doesn't is your Roth IRA. There's no RMD requirement.
So if somebody's saying, okay, Dave, I want to look into this, is there a particular type of a retirement account that you get that could basically greatly impact what you do or how you take those RMDs?
My recommendation for everyone, if you've got the opportunity to do it, my favorite account out there is the solo 401k. Now, you have to be employed by yourself to be able to do this, or have a small partnership where you don't have a bunch of employees inside there. It's just the owners that are running these companies. But that's my top recommendation because it allows you to put so much in to these accounts. I think for this 2023, it's up to $66,000, I believe, is what you can put in there, plus a catch-up contribution. They'll get you over, I think, $73,000 by the time you're done. That is a lot of money going into a plan. Now, all of that can be put in to Roth accounts, or most of it can, not all. Most of it can be put into the Roth side of your aisle. And if you can do that, all of a sudden you get the tax guy off the table and you've got all that money for the future.
All right, Dave, let's move along to my next question here. This one's from Kelly. If you pay out of pocket for medical costs, but have funds you can reimburse yourself with, but die before you can your executor trustee claim the HSA funds?
Kelly, when you look at, so the issue we were saying, hey, if I end up leaving an HSA account that I didn't spend everything down, what's going to happen with that money? Where is that going to end up going? If you have a spouse that's still alive, there are some options there where they may be able to use that money to take the benefit. If not, it's going to have to be distributed out, and your executor is going to have to deal with the consequences of that, the tax consequences, passing it on to your beneficiaries.
And Dave, you also interviewed Roy Rantham, who's the HSA, Mr. HSA, and you guys have a great podcast, and you dive into a lot of specific on the HSA. So I just want to remind everyone about those great resources as we're doing these live shows and podcasts and webinars, all the different features you have out there.
That show was so informative for me, and I appreciate you bringing it back up because he was an individual who helped write the laws surrounding HSA. So some of the questions I'd had that are pretty hard to get answers to, the government's generally not out there promoting some of the answers to questions we often have. He was able to give some answers on some of those things.
And Dave, we'll keep moving on here because I got a lot of questions on here, and we're just about halfway through. My next one here is from Chris. With long-term care insurance getting more costly the older you get, how can someone best afford it?
Chris, it is a challenge, and this is part of the problem that we're dealing with. In fact, the government's going to continue to struggle here because Medicaid ends up providing about two-thirds of the care for those that end up with a long-term care event. And states are not going to be able to continue to keep up with this. There's no way they've got the money to be able to solve this issue. So it's not just you dealing with the problem, it's also governments and other individuals out there that are trying to figure out how we solve unhealthy situations once we get into longevity, or how we solve a disability issue once we get there. My recommendation for everyone is buy the policies as early as you can. If you're going to buy long-term care, again, look at life insurance policies with a long-term care or chronic illness rider. Make sure you're looking at those as well, but buy it, pay for it as quickly as you possibly can. If you can do it, pay a lump sum. There's only a few companies that now will allow you to do that. Most don't, but pay lump sum, if not, do it over a 10-year period of time, because it's going to lock in those benefits and your payouts so you're not subject to paying more and more money over time as these things get more and more expensive.
Dave, what mistakes do you see as people are trying to prepare for long-term care insurance, especially as they're maybe doing it too late, or trying to figure out those experiences?
The biggest mistake I ever see is those who bought it with the expectation they'd pay for it the rest of their life. That was a horrible mistake by anyone who did that, especially with the old policies, because they're designed to where the minute you stop making a payment, the day that you can't no longer make that payment, you're done.
Mm.
All that money you've paid for decades potentially is all gone. Now, some of the new policies are structured to where you can get your money back at least, but the old policies weren't that way. So all of a sudden you're paying, paying, paying. Each year it's getting more and more expensive, and retirement, your income's going down, down, down. Pretty soon you hit this crisis point of saying, am I going to eat? Or am I going to keep my long-term care insurance going that I'm at a point that I really need to have? And people usually choose to eat. So you get to a point where they just let that lapse, and you've lost tens of thousands of dollars for most people once that happens.
And Dave, if we look at long-term care insurance, because again, some people are going to look at this like Chris and say, it's just too costly to afford it. So maybe I'm going to look at maybe doing something else. Is what recommendation do you have?
So you can obviously look at trying to solve it yourself through your own savings, putting your money aside, which some people are able to do that. You can look into family members stepping in, seeing who you've got available. Maybe it's a spouse, which if someone is going to take care of you, I recommend that it be a spouse. Kids usually have a lot of resentment and can create a lot of marital problems for them if they're married, if they have to go through it. And if not, can ruin their retirement. I've got a client that his retirement got completely ruined because he spent a decade taking care of his parents. So all of a sudden he's in a position where he hadn't worked for 10 years, wasn't able to put into his own retirement plan. So now he's in this really bad situation. You can look at the long-term care insurance or permanent life insurance. I recommend Index Universal Life. Buy a policy with that chronic illness rider. You can also look at annuities that will double their payments during a long-term care event. So there's solutions out there. Just got to figure out which one's going to work best for you. And I guess if you're okay to spend down all your assets, take the government option, use the Medicaid benefits that are there, and realize you're going to die broke if that happens.
Yeah, but I think what you're saying, Dave, is just don't put it off. Make sure you're doing something.
Absolutely. It's something you want to solve sooner than later. It's definitely not something you want to go on. We bought policies clear back probably 15 years ago now. So I was in my 30s at the time we bought them. What we paid back then compared to what we'd be paying now, it's almost comical to consider that we were able to get those so cheap, the benefits that we have off of those policies, but they were paid up and going to provide benefits for the rest of our lifetime if we have a long-term care event.
Yeah, that's great, Dave. Let me get over to Mary's question. Is there a way to get a health savings account without having a qualifying insurance plan, or is there another way to save for medical costs in retirement?
Unfortunately, no, you can't, because you've got to have that high deductible plan. And please note too, Mary, that even if you have a high deductible plan, it may not qualify as an HSA deductible approved product. So we have some issues there, but no, you're not going to be able to do that. This means you're going to have to start saving in other buckets. Now, could you put money into a Roth account? Absolutely. Going to be tax-free growth, tax-free distribution. No, you didn't get the benefit of not paying tax initially. Same with the life insurance policy. May be able to use those products where you're not having high taxes when you start pulling that money out and have a little more freedom. But you've got to have that high deductible plan that qualifies for HSA benefits.
Dave, I'm reading this question again here, and it's talking about, again, what other ways do we have for paying medical costs in retirement? It just seems like those costs are just going higher and higher and higher. And we really have to have a plan in place or we're going to be in trouble.
They are. Another webinar they teach is inflation and the rising cost of healthcare, and it is concerning. The average Social Security recipient, which right now gets $1,800 coming into 2023 because of the 8.7% increase we had on Social Security that's going to happen at the beginning of the year. $1,800 CR, they're projecting that this is what most of us are going to spend on just medical costs at someday in retirement. Now, understand, folks, a lot of these states already are trying to figure out ways to get you to pay for this long-term care. 6% of us are all that have signed up. They're saying 94%, we cannot keep carrying this burden. This should not be a responsibility of the government. We've got to push that back on individuals. And so I would expect, and we've got states like Washington that are already doing it, trying to put in policies that they're going to force you to buy. They're going to say, look, if you want any type of care, you're going to have to start putting money in like you would with Medicare to make sure you're going to get these benefits out. We don't know where it all falls, but yeah, the states are like ourselves, and we've proven modern monetary theory doesn't work. They have budgets. They have a set amount of money. Once that money's gone, there's nothing further they can do.
And Dave, you brought up another webinar, so I wanted to bring this up here real quick and let everyone know that you can go to retirementriskadvisors.com/events. And this is where you can sign up for all of the webinars that you're currently teaching right now, Dave. I know right now there's I mean, there's so many webinars you have right now. I think it's 15 or 20 that are going on. You can be able to sign up for these webinars.
We've got 15 right now, I believe. We're going to have over 20 at the first of the year. We've got a bundle of new ones coming out. We just launched our Social Security and Medicare update class. We've also got a new one that's going to be released as part of our summit that we've got coming up, where we're going to talk about 15 reasons you may run out of money in retirement, some of the mistakes you're making and what problems they're creating. Then we're going to add some other courses as we go throughout the year to help people better understand the issues they need to solve.
And Dave, I just do want to pull this one up really quick. This is our Getting Safely Through Retirement webinar. This is a flagship webinar. And so you can get this one. In fact, Dave, you have this one today.
We do have that one today, and we've got almost 500 people that have signed up for this CR already. So very popular class. We teach it every week. Usually have 300 to 500 people register for it, and very excited to be able to cover this topic. The things we cover in this class are so important to helping people better understand where they need to get with their retirement.
And again, you can find that at, in fact, I'll give you the little link here where you can sign up for that particular one there as well, Dave. So you can go to retirementriskadvisors.com/safe, and that'll get you right into that webinar today. So you'll be in a big crowd and hopefully be able to get all that taken care of and just spend 2 quality hours really diving into retirement topics.
Yeah, the best thing about that class is everyone comes out of it and goes, there were so many things I didn't think about. I've met with advisors for decades, and they've never brought up these concerns. And unfortunately, with that obviously comes situations where people are going, I once thought I was okay. Now I'm not so sure. And it's not here to put doubt in your mind. It's to help make you take action so you can solve the problem. So hopefully you can get yourself where you need to be before problems do creep in and you don't have any solutions left to fix them.
All right, Dave, well, let's jump over to our next question here. This is from Jocelyn. If I use the funds from a life insurance policy to cover long-term care, is there tax risk involved?
There can be, but if you structure it correctly, there is not. So what happens is if you over distribute and you end up lapsing that policy, then whatever you put in versus whatever the amount you got out, the difference between the two, you'd end up paying taxes on. You're going to get taxed on the gain, and it's all going to happen in 1 year whenever that policy ends up lapsing. So definitely not something you want, but you need to set it up correctly where you have an overloan protection rider. If you put that into place, that's going to ensure that you don't take too much money out, which therefore will ensure that policy is still available and has at least $1 in there the day you die.
Dave, when they're setting up these accounts, do you find that that's where the most of the mistakes are made as they're kind of diving into this,
Yeah, so it is one of the big mistakes, and not so much with the long-term care issue because it's governed pretty heavily by the insurance company itself. It's going to tell you how much you can take out and these type of things. But we have many people talk about using their permanent life insurance like a family bank. And
Mm.
as good as that can sound in the early years, and we talk about it for distributions in retirement, but we're approaching the end of your life and we've got a lot less time to be dealing with. We see people use these as family banks in their early career, and all of a sudden they pull so much money out they cannot maintain the insurance costs as things go and put themselves at risk of having them lapse once they get into the retirement years, unless they've got it set up where you would have a traditional bank where you're paying that loan back over time. And so you're putting money back into the policy.
And Dave, as you talked about one of your webinars coming up, you definitely dive into some of the mistakes that are being made in retirement. And you can definitely talk about some of these different pieces or aspects of it throughout that conversation.
Absolutely. And you definitely want to know that you never want to lapse a permanent insurance policy. Now, term policy, 99% of them are lapsing, and there's a need for term policies because they're cheap. And during our working years, we can put them in place, pay the low premiums, and be able to have coverage in case we accidentally die and therefore leave something for our family. But you don't want permanent insurance to lapse, because if you do, I will promise you, you will have not only lost money, but you may also have some large tax consequences because of it. So we want to be very careful when we're putting those into place that we're structuring them so they can last as long as we do.
And I just want to remind you, if you are here live, please go ahead and get your question in there, and we'll do our best to squeeze them in with all these other questions. Again, we are here live on Facebook and YouTube. And if you are here through replay, and you can submit your questions anytime on our website. Dave, we just have a few more minutes, so I'm just going to pull up another question here. This one's from Sunny. Can I enroll for Medicare Part B if I am out of the country for a few years and then re-enroll once I am back?
Yes, you can, but it doesn't mean you should. So many times in life, we've got these situations that we can do certain things, but really probably shouldn't do it. And that's what I would recommend here with Medicare. You can unenroll, but understand during that period of time, each year you're overseas, you're going to be faced a 10% penalty that's going to keep going up until you come back. So if you're there for, let's say, 3 years, you've now got a 30% penalty you'll pay the rest of your life. So if you've got 20 years left, out of the country 3 years, and you thought, oh, I'm going to save myself money, that 30% is going to cost you way more than the money you saved by not paying those premiums while you're out of the country.
Dave, it's funny to me because we get a lot of questions in Medicare, but a lot of people just say, "I just want to hold off. I'll claim this when I'm ready." And is even talking about this particular question here, and a lot of times people aren't really grasping what why we're doing Medicare and why we're able to claim it when we should, and not put that off.
Absolutely. And what we see is most people, that especially that we deal with, now I'm not saying for the individual that is only going to be living off Social Security itself and has Medicare there and maybe even on Medicaid, but for most of the people we're working with, this is a small bill to ensure you've got the coverage and do the things you need to do. I mean, right now we're next year $164.90 a month. Now, I realize for some, you may say, hey, but it's a bill I don't have to pay and I want to get out of if I can. Absolutely. We don't want you paying if you don't need to either. But pretty crazy how many people bypass paying that and then end up not understanding the program and pay 10 times or 100 times more because they missed the understanding of how everything worked.
And Dave, I just want to follow up that question with this one, because again, as we're talking about this, if I'm 65 and will still be working, should I sign up for Part A and B of Medicare, or can I put off Part B?
It really depends upon the employer-based insurance that you have available, and I'm assuming that's what you have. Making an assumption here, you may still be you may be on the exchange, which you would definitely want to get signed up. But if you've got employer-based under 20 employees, you absolutely want to sign up for A and B. Over 20 employees, only really need to sign up for Part A, and you don't have to even do that, but no reason not to if you're going to get it for free. But very important, people, as you look at Medicare, don't just assume because you're not getting a penalty that it's okay not to sign up, because there are many underlying areas of Medicare that could end up costing you dearly if you don't understand what you should be doing once you reach age 65 or older, if that's the time you need to sign up for the program.
And Jenny, thank you so much for that question. Dave, it looks like we're just about out of time, and I mean, we're almost to December, which blows my mind for where we are and how quickly this year has gone. What advice, Dave, do you have for those that are maybe putting things off, or they're kind of waiting till the end of the year and maybe trying to make those resolutions coming in January, what kind of things can we help them to look forward to, or maybe fix or adjust in their life?
Yeah, the biggest thing I'm going to tell people is don't even wait till the beginning of the year. Now's the time to start taking action on your retirement. Yes, it's only a month away. And yes, it seems like it's pretty easy to wait until January and then we do all these things to get through the holidays, but it's not like a diet.
Yeah.
We're not in a situation where we got a bunch of chocolates and sugar and all the garbage that holidays bring that ends up affecting our weight during that period of time for so many people. And we want to enjoy all of that. We're in a position to where you can still do some things for this year that could help you for the future. So why not take advantage as early as you can, get started. You can go to our webinar if you want to better understand the things you need to be doing, meet with us to allow us to help you go through the process, but take action now. No reason to wait any longer than what you've already waited if you've not taken action up to this point.
Very well said, Dave. I really appreciate that. And I'm also going to pop up here again, retirementriskadvisors.com/questions. If you did not get your question, that you really just had a question and didn't get it on there, please go ahead and get it submitted there. Again, you can find us on social media. You can even join Dave on every one of his webinars. Again, here is the link for that. So just go to the /events area. You can find all the different webinars there. Dave, you are slammed right now. You're doing events, you're doing podcasts, you're doing live shows. I just want to know how you keep up with it all.
It's been tough lately because obviously I've got a family and all those other things I've got to do, but I'm very excited to do it. I mean, when I look at what we do and I look at the fact that most people that do what I do, they're taking the month of December off. They're not going to be around. They're not going to help you, especially the last couple of weeks. We're here to help. We're here to solve problems. We want to make sure that you're getting the information and the resources that you need to take action. And that pushes me every day to continue to do the things that we do.
Well, Dave, we really appreciate your time and your effort, especially as we dive into retirement. And we hope we'll see you next week, right?
Yes, should be. To my knowledge, I'm not going anywhere. So as long as we don't have any tornadoes that take me out of my house that I'm not expecting, we should be back here.
Perfect. And we'll see you, Dave, and everyone else. We'll see you again next Wednesday, 11 a.m. Central Time. And we look forward to talking to you then. Have a great week.